The first rule is decide what kind of investor you are. And this expands far outside of the resource market. I think every investor should have this conversation with themselves and ask themselves what kind of investor they are. It's the most important question, and it's the question that nobody ever asks, right? Are you a long-term value investor? Are you a swing trader? Are you looking for yield and cash flow? What's your time horizon? What's your risk tolerance? All of these things are super, super important and help you make much better decisions when it comes to allocating cash. But most people never go that far, right? They just start throwing cash at ideas they think are good. That's not a strategy, right? If you get clear on exactly what type of investor you are, everything else becomes easier because this becomes a litmus test for all of your decisions. So how do you go about deciding what kind of investor you are? Here's what I would recommend. The first question you should ask yourself is, how much time do I have to invest in being an investor? And I don't mean just today, but I mean every day, right? Today, tomorrow, next week, next year, et cetera, et cetera. And the reason is because if you have half an hour a week, there's absolutely nothing wrong with that. If you have an hour a week, there's nothing wrong with that. But I might suggest that that's not sufficient time to be picking individual stocks. I don't know if that's enough time to make you competitive right there. And you want to find your competitive advantage. You want to play this game your way, right? You want to play with a winning strategy. You want to know what your competitive advantage is. If you got an hour a week and you think you're going to beat the market by picking individual stocks, I think you should have an honest conversation with yourself. I'm not sure that's possible, but it's a great amount of time to pick some passive products, maybe scale into index funds or ETFs and things like this. Now, I have about 2 hours a day for my portfolio. And after that, I have 2 businesses, 3 kids, life runs away. Now, granted, my business is related to the market, so I get more time than that. But 2 hours a day is ideal for me to be a long-term value investor. It's not enough time for me to be a swing trader and time sentiment in the market and how investors are feeling and what's being overbought and what's being oversold and reading volatility and all of this stuff. It's not nearly enough time for me to be a day trader, but it's perfect for me to find things that are cheap, buy those things, and then sell those things when they become expensive, which is at the core of value investing. Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the 2 most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode. Now, the reason that I stress finding your competitive advantage is because I like to think about this sort of like an arena. And whenever you're buying an equity, if you're buying a share in a company, you are having a disagreement with somebody. And we don't think about it this way. We think, oh, we're just trading shares, right? But you're buying something. And if you're buying something, that means somebody is selling that thing to you. So let's take a company like Tesla, for example. If you were just to go and place an order on your Wealthsimple or your Robinhood app and buy some shares of Tesla, that means that somebody else on the other side of that transaction disagrees with you about what's going to happen in the future of that company. Hopefully, you think this is undervalued and the price is going to go up. And that's why you're buying it. But you have to acknowledge on the other side of that transaction, there's somebody who says, I think it's overvalued and the price is going to go down, so I should sell it. If you can't ask yourself, what do I think I know that that person probably doesn't? If you don't have an answer to that question, then I think you should question what you're doing in that engagement before you square off with this other shareholder, right? So it's important to think about the market that way because this is a competition, right? That's what a free market is. When you get to the core of this, one thing you'll learn is your time horizon, right? A long-term value investor, I like to invest in a company personally And I can sit there for 3-5 years. That's kind of where I sit. Now, the benefit of knowing what type of investor you are and therefore knowing what your time horizon is it gives you the durability to weather volatility, right? I don't know what the share price of a company is going to do in 10 days. I could never predict that, right? But I can identify long-term macro trends. Now, who was at my talk this morning? Was anybody there? Okay, so I like to step back from near-term noise. Like I think about everything in my life this way. The market especially, it's so easy to get caught up in like near-term events and headlines and what happened yesterday and all this stuff. I like to step back and take a long-term view. So long-term value investing is like perfect for a guy like me. But when I'm clear on my time horizon, that just means that if I enter a position and I'm not immediately right? Maybe a month later, I'm down 10%. And 3 months later, I'm down 15 or 20%. I don't have to freak out if my time horizon is 5 years and I already admitted to myself that I don't know what this short-term volatility is going to include. But over a 5-10 year time horizon, I know that we're short this supply and we're going to need more of it. And so I can sit back in my thesis and rest assured that this doesn't disrupt my conviction, right? Because my time horizon is much longer than the near-term volatility.